Afternoon, ladies and gents. Simon Brown here doing this afternoon's webcast looking at stop losses. I just got load shed. Everything's fine. I got backup power and all that's good. But worried about the charts towards the end. I want to do some live stuff towards the end. We'll see how that goes. But we'll do the PowerPoint part first and worry about the rest when we get to it. If you've got questions, drop them into the box. And at the end, I want to look at some live charts with ideas of where a stop loss should be. If you want to look at a particular stock, tell me what the stock is that you're looking at and whether you're looking at a long or a short position, and we can have a look as we go along. Disclaimers, as always, of course. What is important is that today we're looking at traders. So I'm not talking about your long-term holdings, typically those that you're expecting to hold for more than 3 years. And of course, if you're using derivatives, then it's not a long-term holding. So I'm not looking at your investments. Investments have a stop loss, but that's a more fundamental approach to it. What we're looking at today is your trading process. And let's delve into it bits first. So I'm not delving hugely into the what's, the why's, the how's. Been down that road before. We'll go down it again. Okay, we're back. Sorry, we lost some audio there. We will at some other point go back, revisit. But the point is that a stop loss is a critical component of everything a trader needs. Without a stop loss, you go bust. Sooner or later, you'll go bust. And I appreciate they're emotionally hard. There's a lot around that, and I talk around that a lot. And you know, the biggest trick is you see them triggered, and then the stock goes rushing off in your direction. So you're long. There's a small pullback. You get stopped out. Stock goes without you, and you're left behind. The trick with them, and that's why I want to talk today and look at some live charts, is that really what we're looking at in most cases is people are placing their stop losses too tight. You know, you're on a share and you stick a 2 or 3% stop loss, and that is just too tight for a stop loss. You've got to give it wiggle room. You've got to be prepared for the actual loss. If you're trading and you get stopped out and you're going to lose X amount of rand, what is that X amount of rand? And how happy are you that you will lose that X amount of rand? And of course, 2% rule, which is not the size of your stop loss. 2% rule is how much capital. Video link there. I'm going to park that there for now. We don't need to delve into that. Problems that we run into is that we ignore them. A stop loss gets triggered and we emotionally or financially can't take that hit, so we ignore it. We set them too tight. We give them wiggle room when they hit. Stop losses hit and it's like, it'll recover soon, and we can't afford that financial loss. One of the big issues, particularly in the wiggle room part, is liquidity. And if you're trading stocks, particularly if you're trading geared stocks in a geared situation, you need serious liquidity. You can pretty much trade the top 50 or 60 stocks in our market. Don't go beyond that, because liquidity is what's going to hurt you. What I mean by that is, suddenly someone does drops a lot of shares to sell and the stock drops 5 or 6%, and then bounces back minutes, hours, days later, and it's literally one seller who did it. Are they manipulating? No, they're getting out. It's just that simple. So you got to make sure that you stay away from those low liquid stocks, because you're just going to get hurt when the liquidity dries up. And at this point in time, and I did a podcast on it last week, at this point in time, what we are seeing is a humongous lack of liquidity, especially in the second tier, sort of small and mid-cap LTEX shares. Liquidity's disappeared. Quality companies are falling, and that's not going to change anytime soon. Liquidity will return to the top 40, and then eventually in time will work its way down. Don't trade outside the top 50, maybe 60 shares. My rule of thumb, and I haven't looked into it recently, I need a share that's doing 10 million a day. 10 million ZAR per day. That typically gives me enough liquidity. So let's look at different types of stop losses, trailing versus fixed. A trailing is basically you say, I want to trail by a percentage or a rand value or a point value if you're trading an index, and you stick it on and off it goes, and you can leave it to be. No problems whatsoever. Nice and simple. In the process of setting it up, very easy to manage. As the trade goes in your direction, the stop loss moves along. So let's say you want to trail by a rand, you're in a long position, the share is 10 rand, your stop loss is 9. Share moves to 11 rand, your stop loss is now 10 rand, because you're trailing by 1 rand. If you were trading by 10% when you entered, your stop loss was 9 Rand. At 11 Rand, your stop loss is now 9 Rand 90 as you trail it up. Easy to manage, but it's a dumb stop loss. And what I mean by that is, in the previous example, the share moves to 11. Your stop loss is now 990, 10 Rand. Excuse me. There might be a significant support sitting at 980. In other words, it might drop a little bit lower, and that's what I mean by it's a dumb stop loss. And I use it a lot, and I'm using ATR, and I'll talk about that. Fixed is where you physically eyeball the chart, and you say, and this is what I want to look at a lot today, where you're eyeballing that chart, and you say, I want to put my stop loss here, and as the price is moving in your direction, you're repositioning that stop loss and sticking it where it needs to be. It's less dumb, because it's using the trader. There are two risks to it. The big risk is that it requires honesty from the trader. In other words, you need to manually change it, and that's the second risk. You've got to get on every so often, manually change it, but you need to be honest when it's triggered, because now it's you. You said that 980 was the point, and it went to 975. Now you've got to bail, and you're like, well, maybe it was 970. Whereas if it's just a trailing stop, it just runs and it happens. With the fixed, intuitively, I think it's better, and there's a great way we can practice, is basically create a watch list of the top 50 shares on the JSE in terms of liquidity or in terms of market cap, the top 40. That's a good enough list. And then go and draw stop losses on every single one of those shares. Decide whether it's a long or a short trade. Just eyeball it. Is this thing going up or down? And draw stop losses. And just keep on putting stop losses. Come back every day. Come back every week. How's your stop loss? How's it responding? What you're doing is you're learning that skill of where to position the stop loss. And that is critically important. And it'll help you in time. And do that, check those charts, I don't know, every day, every week. Do it for months, do it for a year or so. And you'll learn not just the general art of where to place a stop loss yourself, but you'll learn specifics to companies. You'll learn that with Sasol, it likes this type of range, and you've got to give it X wiggle room. You'll just get smarter and smarter at it. So trailing or fixed, pros and cons, up to the individual, truly is. The other big question is end of day or intraday. So in other words, do you trigger immediately when that stop loss is hit? Now, that is the much more aggressive way to do it. It is the classic way that most people are going to action a stop loss. And truthfully, it's probably the correct way to do a stop loss. But what we do see is oftentimes is a stock will trigger a stop on a shake of news or someone exiting, but won't close below it. And there's a significant difference. When we're looking at charts and the like, I always use candles, but those close prices are what matter. The wicks are of interest, and they give me an idea. But it's not critical to the process. It's those closes that are critical. Ivan and others are commenting on sound. Yeah, it did just improve. It is just my internet. I'm on backup, and unfortunately, everyone in my area is probably on the same backup I'm on at this point in time. Nothing I can do about it. I am recording at that point. So, it's a tough decision, and the risk of doing it on a close, whether it be an hourly, daily, weekly, whatever, on doing it on the close is, if we take a look at, for example, EOH or Wilson Bailey Holmes yesterday, is that both of them would have gone crashing through your stop loss and closed significantly lower, which means losses can be larger than your actual stop loss. There's pros and cons to it. If you do it on the close, there's sometimes when you simply won't get stopped. It'll go below the stop and then rally up again, and you won't get stopped. But then sometimes it'll hit that stop and carry on going. It's a personal decision, and I do it different ways. When I'm trading Aussie futures, I am triggering on hit. If you hit me, I'm out. End of story. But when I'm trading my weekly ETFs, I'm doing it on a weekly close. Now, there's a couple of key distinguishers. They're both indices, so they're less volatile than equity. When last did we see an index lose 20+% in a day? There were at least two stocks doing it yesterday. Truthfully, the last time it happened in an index in South Africa was 1987. So 30 years, it'll be 32 years in October. So we do get a lot less volatility in them, but also Aussie futures is geared. Now, I'm running at 10 Rand a point per contract. So what I don't want is to lose an extra 1,000 points. So you hit my stop loss and I'm out. End of story. On my ETFs, which I'm entering on a weekly chart, and they're fairly relaxed, I'm saying, you know what, you got 5 days to recover. And yes, sometimes it hurts, but that hurt is in percentages. It's not geared. If you're in equity, you probably almost certainly want to do it on trigger, just simply because of that extra risk of what we saw with EOH yesterday. So triggers, let's look at those and go to some specifics on the triggers. What do we use? We can use a technical, in other words, a moving average or something like that. What it does is it takes the pain out of our hands, because we're just saying, well, it's a moving average. It's not me eyeballing the chart. The problem is it needs to be manual. You can't say to the online share trading system, if we close below the moving average or the moving average crosses, get me out, or MACD or RSI or whatever the case may be. So you've got to manually adjust it at all points. Some, such as average true range, which is my preferred in the technical space, is nice. It gives you a value and you're off to the races. Typically what I would either do is draw your, eyeball the chart, or I use an average true range. And what I'm usually doing on average true range is, if I'm in a daily chart, I'll use daily times 2 average true range, or I'll drop to the weekly chart and use the weekly average true range as my stop loss. Eyeballing is literally just checking the chart for the best place to position it. As I said, it can be emotionally hard, but it does mean that you have a smart stop, depending on obviously the smarts of the trader. And that's what I mentioned a moment ago, where I said you go and practically practice on doing it and on managing it and on making it work. So you got a smart stop loss, but it means that it's the trigger is fair and square on your shoulders. It's not average true range where, yes, the decision to use ATR is the traders, but beyond that, it's then like, well, ATR said 7 and it went to 8 and therefore I was stopped. As soon as you're drawing those own stop losses and saying, this is where I think it's going, then it's you that's on the front line. And that, as I said, can be painful. So let's go and look at a couple. Folks, if you've got, let's hope this works. Let's do a test here. Okay, so we do seem to be working here. So I'm going to haul up some charts. You can see I've got ATR as my default down at the bottom here. And I'm going to sort of put some ideas of where I would be positioning stop losses. And if you've got stocks you want to particularly look at, let us know some of those and we'll bring those into the equation as well. Woolies right now, would there be any reason to be long? Not so ever. Where would you place a stop loss on Woolies? Well, the first point would be your gap close. But truthfully, I think your better point on Woolies was probably round about there, which is about 12%. On an equity, I would be looking for a stop of around 8-ish, maybe 10-ish. So maybe on Woolies there. Now, what have we got? If we've switched to a line chart, what you can see with Woolies is lower highs and lower lows. So if you want a really aggressive stop loss, you put it there at about 46.80. But that's about 3%. To my mind, that's far too tight. Where's your less aggressive stop loss? You would stick it up there at around 49.80, which is running at about 6.5%, 7%. If you're running an ATR stop loss, you'd be running it at about 3 Rand 20, which is at about the same sort of 8 or 9%. So you can see they kind of converging. Why is my ATR 320? Because my actual ATR level is 150, 160. Double it, gives you 3 Rand 20 in that sense there. Greg, nope, the audio is bad because I'm on backup internet. It's usually on my fiber, which is 100 meg upload. I'm currently on MTN. I think I'm on HSDPA plus, so audio is really, really bad at the moment. Questions coming through on Capitec. Let's see. So Capitec, your only position you would be in would be long. Where would you be positioning your stop loss? You could put an aggressive stop there. I think that's far too close. I think you'd be looking to put your stop loss down there at about 11.30ish, which is about 6 or so percent. Your ATR would be a 60 Rand stop loss, would be around 11.50ish. What am I saying with the stop loss down there for Capitec is that if it's going to pull back, is it going to come back to those levels there? Sure. That's totally to be expected in a sense. Is it going to breach that low and in essence get back into that zone over there? If you're saying Capitec's going higher and it starts breaching recent lows, and that is a daily chart, so that lows from beginning of Feb, it's just 9 days away, 7 days excluding the weekends. If you want to be really gentle on your stop loss, you're probably sticking it down here at about 1100. 1150 or so, and that would be my preferred space for the stop loss, which means it's given back all of these returns since early Jan. So if it's giving back a month of return, you got to say your idea that the stock is moving higher is probably wrong. You also, a question coming through, I think it was Sumitra, who's saying she feels that she often gets shaken out of a stop loss. And absolutely, I know exactly what you mean by that, where it comes down to you, hits you, and then goes without you. Now, in low liquid environments, that's entirely possible. Now, if you're putting a stop loss in a very obvious place, if you're putting it sort of exactly there, traders are going to be, lunchtime, not much happening. Let's push the stock down. Let's try and see if we can't trigger some stocks, which is why you got to say, if you want to trigger me, come down to 1125. You got to really, really now be moving. You got to, and even someone saying, what about 1100 on the nose? Sure, 1100 on the nose. That's not a bad place to have a stop loss. It's about 8% away. You might even want to then go down to around 10,080, 1,080, 1,090, giving it a lot of space to run in that process. Question coming through about BHP. Folks, I know audio is bad. If you got any stocks you want to look at, drop them in the Q&A box. So BHP Bulletin, your ATR is saying an 11 Rand stop. I think that's a little tight. Where's an obvious place down there at 280? Probably giving it too much space. Probably put your stop loss round about there. So around the 292 level, that's about 20 Rand away. It's about 7% on it. Wilson Bailey, nice example because so Wilson Bailey, if you were long, if you were long, your stop, I'm not sure why you would have been long, but you would have got stopped. But a great question at this point. So let's say you're short, and when you initially short, your stop loss was up there at around the 152, 150 level. It's now completely collapsed. What do? So what I'm going to do here is I drop 2 candles and I say, let's put the stop about a third of the way back up that candle, third or a half. So put your stop around the 125 level, 122 level on that large candle there, which was yesterday's collapse. And you would be looking to do ditto on the EOH. There we go, EOH loaded up. If you were short here, let's ignore the hows and whys. Where was your stop initially? Would have been around the 34.40 level, maybe 35 level. As you traded down, you would have moved it down to that sort of zone at around the 29 level. And now you would move it to around half or a third. You would move it to around 22.50. Taking it about a half or a third of the way down that express candle there. And again, I'm focusing on the body of the candle, but what you're looking at there is around the 22.50 level is now your stop loss. And that's because leaving it all the way up there, no. I mean, let's see it might consolidate over the next few days. You could, of course, just drop it to a trail. Trail's 450, that's 23, which is kind of coming in with my other view on where to position that stop loss. Growth point. So if you were long of growth point initially, let's say you're long down here, your obvious stop loss point is probably about there. You can see that you're below that initial bit here. You're below those lows of October and sort of late September. The stock then ran. You move your stop loss to there. You move your stop loss to there. At this point, you are probably sitting, and today or maybe yesterday, you're probably then stopped out of the stock because it was probably then floating around the 25 Rand level, and now is the time to get out. Question is, if you can use this on indices, you can, but use the index, not the ETF. And we'll just look at the pure index. The J210 is the Resi. Resi's making a nice break. Where's your stop loss? You could put it there. It's a little tight at probably about 5%. Otherwise, you want to put it down there. If I go quickly to Sandpit, and let's look at J210. So this is my lazy system on it. And I'm using the 30-week EMA. So I'm using that red, which is about 40,676 as my current stop loss, which is about 8%. And that's reasonable, particularly in an ungeared environment. Let's quickly go and practically log on and let's look at the process of placing stop losses. I've been kicked out here, so let's log off and go back in. Yeah, my internet has died to a crawl. So let's take these all ETFs. Let's take that one. You're clicking on the lightning bolt at the end. That's both a stop loss and an alert. You can run it either way. Speed test not even loading. Or you want a stop loss for price alert, you would click stop loss. Do you want fixed or trailing? If you hit fixed, and these things are going to be live until they are triggered or until they are cancelled by yourself. The difference being is if you're running with the expiry products, obviously they'll expire as the product does. Do you want to trail by a percent or a Rand value? How much are you prepared to exceed it by? In other words, the order to market and the quantum that you want to send it to. So this will then trail, and as in this case the ETF moves, you will then find yourself that stop loss will be moving in your favor. If we do a fixed stop loss, then it says at what price do you want to trigger and what price do you want to go to market. Because remember, your trigger might happen at 16, but you might not be able to trade at 16, so you might want to send to market at 15.50 to make sure that you actually do trade. Bidcorp. Question coming around. Bidcorp. So where's the stop loss in Bidcorp? On a 290 stock, you're sitting at around that point there, which is 274. Or maybe down there at 255. That's too far away. I'd be putting my stop there at around probably 273 for a Bidcorp stop. Richmond for a short position. And now internet's so bad that it's not even picking up the codes and not loading and not whatsoever. Folks, I'm going to park it there for today because there's the struggles here with our lack of internet connectivity. What I will do is when we're not load shedding, let's do a session where we can just look at the stop losses, etc. We'll send a mail out to advise of that. Now my internet is back in biz again. Yeah, but load times have collapsed off the face of the earth. question around managing them. So once you've got stop losses, you go to stop loss and alerts. And at this point here, and you won't see anything because I don't have anything there. Under my account, stop loss and alerts is where there are some there where you're able to get audits, you're able to get details, and if you've got any live ones, you're then able to trigger to amend them, or if need be, is to cancel them. Ladies and gents, I'm going to park that there for now. As I said, let's come back. The webcast will be online. I'm going to check to see if I can pick up on the audio. It might be better on my side because I think it's recorded at source. We'll see how that goes. And I'll reschedule a session where we can do some examples where we have real internet. So we'll park it there for now. Ladies and gents, thanks very much for your time. Until next time, cheers all.